A man who started his career working the handkerchief counter in his father's small linen store, who built his first business at 14 by mowing lawns he never actually mowed himself, and who began his Wall Street career as one employee among thousands at a single investment bank. He had no family fortune, no inherited stake in a great financial institution, and no guarantee that anyone on Wall Street would take a meeting with him once he decided to go out on his own. Yet by the time he was finished, he had built an investment firm that managed more money than the gross domestic product of most countries on earth, had personally orchestrated some of the largest and most profitable transactions in financial history, and had transformed an industry once dismissed as a niche corner of Wall Street into one of the most powerful forces in the global economy. He was doubted, underestimated, and counted out more than once, and each time he answered with a deal larger than the last. This is the story of Stephen Schwarzman, and how a man with a talent for spotting value where others saw risk built Blackstone into the largest alternative asset manager the world has ever seen. Stephen Alan Schwarzman was born on February 14, 1947, and raised in Huntingdon Valley, a quiet suburb north of Philadelphia, in a Jewish family of modest comfort rather than great wealth. His father, Joseph Schwarzman, ran a dry goods and linen store in Philadelphia, and from age 10, Stephen worked the ladies' handkerchief counter on weekends, watching how customers behaved and what made them buy. The lesson took the form of observation, repeated until commerce became something he understood instinctively. At 14, he started his first real venture, a neighborhood lawn mowing business. Rather than push the mower himself, young Schwarzman positioned himself as the businessman of the operation, bringing in the customers and the contracts while his twin brothers, Mark and Warren, did the actual mowing. It was a small operation, but the instinct was not small at all. He had already grasped, before most people grasp it in adulthood, that the person who controls the relationships and deal terms is worth more than the person doing the physical labor. Schwarzman attended Yale University, where he proved as ambitious in his extracurricular life as he would later be in business, helping found a campus ballet society and securing membership in the elite Skull and Bone Society. After Yale, he went on to Harvard Business School, then began his career at Donaldson, Lufkin and Jenrette, before moving to Lehman Brothers, the storied bank that would shape the next chapter of his life. At Lehman, Schwarzman did not simply participate in mergers and acquisitions. He came to dominate it, rising with unusual speed, becoming a managing director at 31, and eventually taking charge of Lehman's entire global M&A practice. He developed a reputation for an almost obsessive attention to deal structure, for staying on calls late into the night when a transaction was at risk, and for an intensity that made colleagues either deeply loyal to him or deeply wary of him. By the time Lehman merged with Kuhn Loeb in 1977, Schwarzman was already recognized internally as one of the firm's most formidable rainmakers. But the environment that had made Schwarzman's rise possible began to change in ways he could not control. In 1984, his mentor Peter G. Peterson, Lehman's chairman and chief executive, and a former United States Secretary of Commerce, was pushed out of the firm's leadership in an internal power struggle. Schwarzman, who had built much of his career under Peterson's patronage, found himself managing the very transaction that would dissolve the Lehman Brothers he had known, its 1985 acquisition by American Express. He helped guide that deal to completion, but once it closed, there was no clear path forward for him inside the newly merged institution. Rather than wait for a role to be carved out in someone else's organization, Schwarzman walked away from the security of an established Wall Street institution and partnered with Peterson to build something of their own. In October 1985, Stephen Schwarzman and Peter Peterson founded the Blackstone Group. The name was a quiet tribute to its founders, combining Schwarz, the German word for black, with Peter, derived from the Greek word for stone. The firm's beginnings were modest almost to the point of fragility. Schwarzman and Peterson started with just 2 employees and less than $500,000 of their own capital, setting out to compete against entrenched Wall Street giants like Goldman Sachs, Morgan Stanley, and Salomon Brothers. Firms with armies of bankers and balance sheets that dwarfed anything Blackstone could offer a client. Blackstone initially positioned itself as a boutique M&A advisory firm, built around offering conflict-free advice to corporate clients growing wary of large banks with competing interests in the same transactions. To build a client base from nothing, the 2 founders sent hundreds of outreach letters to corporations and institutional investors, slowly building the relationships that would become the foundation of one of the most powerful financial institutions in the world. The early going was difficult, and not every decision worked out. From the beginning, Schwarzman and Peterson had planned to move beyond advisory work into private equity investing, but they struggled to raise their first fund because neither had ever personally led a leveraged buyout. A serious credibility gap for two men trying to convince pension funds and insurance companies to trust them with hundreds of millions of dollars. Schwarzman absorbed the rejection and kept pushing. Slowly, the firm's advisory reputation began to generate momentum. Blackstone landed an advisory engagement with Drexel Burnham Lambert that gave the young firm critical early credibility, and in 1987 it advised on the merger of E.F. Hutton and Shearson Lehman Brothers, collecting a fee that, while modest by today's standards, validated the entire premise of the firm's existence. That same year, Blackstone finally closed its first institutional private equity fund, Blackstone Capital Partners I, raising $800 million anchored by a $100 million commitment from Prudential Insurance. The two-employee firm that Wall Street had been skeptical of just 2 years earlier now had real institutional capital behind it, and Schwarzman intended to put every dollar of it to aggressive use. One of the most consequential decisions of Blackstone's early years had nothing to do with a leveraged buyout. In 1987, two young financiers, Larry Fink and Ralph Schlosstein, approached Blackstone for seed capital to build a fixed-income asset management business, an operation that would become BlackRock. Schwarzman backed the venture, building it into a 50-50 partnership inside Blackstone's own structure. The bet paid off handsomely as a business, but Schwarzman would later regard the way it ended as the costliest mistake of his career. In 1995, seeking liquidity, the firm sold its BlackRock stake to PNC Financial Services for $240 million. Between 1995 and 2014, PNC alone collected $12 billion in pre-tax revenues and gains from that stake, as BlackRock grew into the largest asset manager on the planet. Schwarzman would later call the sale his worst business decision ever, a reminder that even his instincts for value were not infallible. He absorbed that lesson the way he absorbed every setback, not by retreating from risk, but by recommitting to the businesses he believed in. Through the 1990s, Blackstone expanded methodically across the asset classes that would eventually make it the most diversified alternative investment firm in the world. The private equity business raised progressively larger funds as its track record lengthened. Blackstone's third private equity fund closed in 1997 with roughly $4 billion in commitments, alongside a $1 billion real estate fund, signaling the firm's growing ambitions beyond corporate buyouts. That same year, Blackstone made its first investment in Allied Waste, later expanded in partnership with rival Apollo Management to finance Allied's acquisition of Browning Ferris Industries. In 1998, AIG purchased a 7% stake in Blackstone's management company, valuing the still relatively young firm at over $2 billion, and confirming that the institutional world now regarded Blackstone as a permanent fixture of finance rather than an upstart experiment. Real estate, however, proved to be the area where Schwarzman's appetite for scale reached its fullest expression. Blackstone built a real estate platform that moved aggressively into hospitality, acquiring Prime Hospitality and Extended Stay America in 2004, followed by La Quinta Inns and Suites in 2005. Each deal was larger than the one before it, and each reinforced the philosophy that had defined Schwarzman's thinking since his earliest days at the handkerchief counter. Find assets the market has mispriced, take control of them, improve their operations, and realize the gap between perception and reality as profit. In February 2007, Blackstone executed a $39 billion buyout of equity office properties, then the largest leveraged buyout ever completed. It would not hold that record for long because Schwarzman and his real estate chief, Jonathan Gray, were already pursuing a far larger and more audacious target. That target was Hilton Hotels Corporation, a name synonymous with American hospitality since Conrad Hilton founded it in 1919, but which by the mid-2000s had drifted, losing ground to sharper competitors and trading at a valuation Gray believed badly understated its underlying real estate and global brand. Gray had been studying the opportunity under the code name Project Murphy since the summer of 2006, building the case that Hilton's properties were worth significantly more than the market credited them for. In July 2007, after negotiations that included earlier rejections and price disagreements, Blackstone agreed to take Hilton private in an all-cash deal valued at approximately $26 billion, paying $47.50 per share. The transaction was financed overwhelmingly through debt, with roughly 78% of the purchase price covered by borrowed money. an extraordinarily leveraged structure even by the standards of the 2006 to 2007 buyout boom. It was one of the boldest bets of Schwarzman's career, and the timing could not have been worse. Just days after the deal closed, global credit markets began to seize, and within months the world was sliding into the most severe financial crisis since the Great Depression. Within 18 months, Hilton's global revenue fell 20% and its earnings collapsed by 40%, forcing Blackstone to tell its own fund investors that billions of dollars of the value it had paid had effectively evaporated. Blackstone ultimately recorded impairment losses of more than $5 billion, and for years commentators openly speculated that Hilton might collapse into bankruptcy, taking Blackstone's reputation down with it. Schwarzman did not panic and did not sell. Through 2009 and 2010, Blackstone restructured Hilton's crushing debt load, negotiating with lenders to reduce borrowings from $20 billion to $16 billion while extending the maturity by 2 years, injecting fresh equity from its own funds to make the restructuring possible. Blackstone also installed new operational leadership, bringing in Christopher Nassetta as chief executive to refocus growth around a lighter asset, franchise-driven model that could expand globally without Hilton owning every property under its brand. The recovery, when it came, was not gradual, it was spectacular. As the global economy clawed back from the financial crisis and travel demand rebounded, Hilton's restructured operations and expanded franchise footprint let it grow faster and more profitably than nearly anyone believed possible during the darkest days of 2009. In December 2013, Blackstone brought Hilton back to the public markets in the largest hotel industry IPO in history. By the time Blackstone fully exited in 2018, it had converted what once looked like a catastrophic, crisis-era misjudgment into one of the most profitable private equity transactions ever recorded, generating an estimated $14 billion in profit across 11 years. The deal would later be described as the greatest leveraged buyout in history, not simply for the size of the return, but for the nerve required to hold the position when nearly every signal suggested it should be abandoned. The purest distillation of the lesson Schwarzman had absorbed from the BlackRock sale. Conviction, sustained through adversity, was where the largest returns were made. Even as Hilton dominated headlines, Schwarzman was pursuing a different kind of milestone. In June 2007, weeks before the Hilton deal closed and months before the financial crisis began unraveling global markets, Blackstone took itself public on the New York Stock Exchange, allowing ordinary investors to buy a direct stake in the profits of a private equity firm for the first time. The timing looked almost impossibly fortunate. Blackstone completed its offering at the absolute peak of the pre-crisis boom, locking in a valuation far harder to achieve just months later. The IPO filing revealed for the first time publicly the scale of compensation Schwarzman's strategy had generated for himself, disclosing roughly $398 million earned in the previous fiscal year alone. He personally received over $680 million for the stake he chose to sell in the offering, while retaining a remaining stake then valued at over $9 billion. The disclosures drew intense scrutiny over the scale of private equity compensation, but Schwarzman did not retreat from the spotlight. He had built a firm the public markets now valued at nearly $40 billion, founded 18 years earlier, with 2 employees and less than $500,000. In the years following the crisis, Blackstone's growth accelerated as Schwarzman pushed the firm aggressively into new lines beyond its original private equity and real estate roots: credit investing, hedge fund solutions, infrastructure, life sciences, and direct lending among them. Each platform followed the logic that had shaped Schwarzman's thinking since childhood. Identify a pool of capital the existing financial system was serving inefficiently, build the expertise to serve it better than anyone else, and scale that advantage relentlessly once proven. Assets under management climbed past $100 billion, then several hundred billion, growing not merely through market appreciation, but through Schwarzman's insistence on continuously launching new strategies and aggressively recruiting talent to run them. As he later explained the philosophy, hiring becomes easier once an institution proves its staying power. In Blackstone's earliest years, top talent saw the firm as too risky to join, but as the platform expanded, the best investors in the world began competing to work there. By late 2023, Blackstone had crossed $1 trillion in assets under management, a threshold no alternative asset manager had ever reached, and one that would have sounded like fantasy to the 2 men who founded the firm with $400,000 in borrowed conviction and almost no leveraged buyout experience between them. The growth did not stop there. By the first quarter of 2026, Blackstone's assets under management had reached $1.3 trillion, the first alternative asset manager in history to cross that threshold. A figure larger than the entire gross domestic product of all but a handful of nations on Earth. Schwarzman, well into his 70s, remained the firm's chairman and chief executive, still presiding over the institution he and Peterson had built from a two-person office with no guarantee the model would ever work at all. What the financial world ultimately absorbed about Stephen Schwarzman was not simply the scale of the fortune his strategy had generated, though that fortune was almost impossible to overstate. A personal net worth that, by the mid-2020s, had grown to tens of billions of dollars, built almost entirely from his ownership stake in the firm he founded. What it absorbed was the demonstration, repeated across 4 decades and multiple financial crises, that conviction sustained through adversity was the single most valuable asset in finance. He had walked away from an established institution with no certainty that 2 employees and a few $100,000 could compete with firms 100 times Blackstone's size. He had absorbed the costliest mistake of his career in the sale of BlackRock and refused to let it diminish his appetite for the next opportunity. He had watched the Hilton deal nearly collapse under the worst financial crisis in 80 years and held his position anyway, converting what could have been Blackstone's defining failure into its most celebrated success. In 41 years, that combination of instinct and nerve built the largest alternative asset management firm the world had ever produced, transformed private equity from a niche corner of Wall Street into a central engine of the global economy, and proved more convincingly than perhaps any financier of his generation that the willingness to hold a position when everyone else has lost faith in it is very often where the largest fortunes in finance are ultimately made.